On this episode, we talked about crypto again, RRSPs, and what to look for when you're choosing your advisor. I'm Scott Goodfellow. This is Ben Hart, and this is Think
Think
at Heart.
nice. Let's go. I'm
All
ready.
right.
Fired up.
Episode number 3. Feels like we've done 100.
Yeah.
Hey?
Yeah, for sure. For
Hey?
sure. Getting lots of positive comments about my Hawaiian background on our weekly roundup last week.
Oh my God. What a poop show that was. Hey? That's the thing, eh? When you have technology is great while it works. When it
Yeah.
doesn't, it's frustrating as all heck.
Yeah.
But yeah. Anyway, we got through it.
We did.
Episode 3.
Yeah.
We're getting the hang of things. Uh, people have been asking too, what's in the mug, and if
Yes.
I was a drinker, but I'm not, so it's water.
It's very true. Very true. The drinking days are long gone, right?
Oh, I know. I can't handle it. It's the
Yeah,
hangovers you can't handle.
for sure.
All right, so let's get right into it.
Okay.
Uh, big week, big week in the markets, big week in the world, the economy, with
Yeah.
the elections.
Yeah.
Why don't you bring us up to speed with what's going on in the world?
Yeah, it was. I mean, it was a big week. There's lots going on. Obviously, change of leadership in the U.S. was a big thing. This pandemic continues to roll on, and it looks like Biden's going to take a different tact as he comes in. You got the economy starting to continue to heat up. But obviously over the weekends, I spent a lot of time trying to catch up on what I missed throughout the week. And so there's a few things that I read this weekend that kind of triggered me a little bit. I've talked often about the U.S. dollar being a big driver of all things, and so for the first time in a really long time, we saw a higher low in the U.S. dollar, and that is a signal to pay attention to. If you continue to see those higher lows, tends to indicate a sign that maybe the U.S. dollar is strengthening and some of those other assets are weakening. So it's something that causes me to pay a lot of attention to. The other piece, obviously, we'll talk about is crypto, but I read a great institutional piece on what institutional managers are thinking about it, what it is that their issues and concerns are, and what the potential is. So lots to cover there. Made a few changes last week, which we can chat about a little bit, but nothing really material from a changing perspective. There's a couple of companies that I think we've watched and talked about a little bit here and there, like Galaxy Digital was one that we've been watching that they have a good blockchain behind them, and Novogratz is the CEO of the company. Um, so definitely lots happening, but that US dollar that I read about this weekend is something I pay a lot of attention to, and something that I'll be watching closely this week.
Yeah, I mean, it seemed like it seemed like there was a lot going on in the world, but the market didn't really react that much to it, would you say?
Not much at
No.
all.
No.
Yeah, yeah.
Is that a surprise? Is that really a surprise?
Not really. I mean, tends the seems to be a lot of hype leading up to president coming into power. Obviously, when Trump came in 4 years ago, 2016, that was a crazy evening from a volatility perspective. When around midnight, when I was watching the markets, you had futures down, like Dow futures down like 1,200 points. I thought it was going to be a great day to buy. By the time we got to the open, the markets were up.
Right.
So, unless you're an institutional investor trading in those after hours markets and be able to participate in it, you miss that whole turn. But with this kind of view that Biden was going to come in and he's going to be a lot like we saw him before. He spent 4 years in the White House as the vice president. We got a pretty good picture for what he's like. Janet Yellen's going to be secretary treasurer. She was head of the Federal Reserve. We know what she's going to be like. We know what Powell's going to be like. So when you got three of the major players and driving economic activity in the U.S., you get a pretty good picture for what to expect. So I think we saw some of that. Obviously, the market sold off a bit on Friday, nothing material, but I think the market's now digesting, saying, where do we go from here? But
Right.
yeah, I think
What?
we got known entities.
Right.
Yeah.
What is the market and the economy? How do they usually react to going from Republican to Democrat? Is there usually any difference there? Is one better for the economy than the other?
That's a good question. So I think that historically speaking, anyways, that the markets have been a little better with the Democratic leadership. And so I'd say from an economic perspective, yeah, I can think there's a kind of a school of thought that Republicans are better for the economy, but historically, from a market sentiment perspective, the Democrat leadership has been better.
Right.
Yeah.
Gotcha.
Yeah.
Gotcha. All right. Well, um, so what are we dealing with in our day-to-day business right now? I can tell you from my standpoint is we're getting a lot of requests for people to top up the TFSAs.
Yep.
Right. Not a
Yep.
lot of change there year over year. The maximum is still $6,000,
Yep.
if I'm correct about that. And we got RRSP season ramping up too. So we have a lot of clients are just talking about that right now, right?
Oh, for sure. Yeah.
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 So how do we handle that from our standpoint, like as the advisors? What's what's our typical um, approach to these types of things?
Yeah, I think that a thing that I think that I have lots of conversations with, which I've had over the last couple of days, even around should I continue to contribute to my RSP. And so I met with a client recently who's got a corporation, they have an RSP, they got lots of money saved in the corporation and their RSP. They've maxed out their tax-free savings account. They're also putting money away into a corporate estate bond, which is permanent insurance, which we could talk about on another segment. And so they've been a really good saver in all these buckets. And so we start to have those conversations around, should I continue to put money into my RSP now that it's, we'll say, $1 million, or should I leave money in the corporation and have it grow there? And so I think RSPs are still pretty misunderstood when you think about things. I still have conversations with clients and say, well, I didn't know I could buy stocks in my RSPs, or I didn't know I could do this in my RSPs. And so, there's a couple of things. I mean, the first thing is that an RSP is just an account, just a bucket. Like within that bucket, you can put in there whatever you want. You want stocks, you want bonds, you want GICs, you want mutual funds, you want ETFs. You can put anything you want in that RSP bucket. So it's just a bucket, it's just a holding place. Now, when you contribute to it, that's where we start to have more further conversations. But I'd say that first of all, it's just a bucket where you can hold whatever you want in there. So that's kind of step one when I think about RSPs from a simplistic perspective.
Hmm.
But then the question is, should I continue to contribute to it? And so there's kind of this misconception that, well, I'm always going to pay tax on it anyways. Why would I put money in there?
Hmm.
Well, for example, if you're in the top tax bracket today, right, and you don't have a pension, and so you're saving for yourself, and so you're paying 53% or so in the kind of the top tax bracket. And so if you put $100 into an RSP, you're going to get back essentially 50 cents on that dollar. Okay,
Mm.
so why is this relevant? Well, that's positive, of course. You want to get some tax money back. But the reason you put it in now is because potentially in the future, say you get to be age 65 and you have, we'll say, $1.5 million in your RSP, and you don't have a pension, you don't have any other income. Maybe you start drawing CPP and OAS, or maybe you don't. Maybe you defer it. And say you defer it to age 70, CPP and OAS, then all you have from an income perspective is your RSP. So from 65 to 70, maybe you say, I'm going to start drawing income out of my RSP. Okay, so you start drawing income out of the RSP. Your first 15,000 is tax free, and then on top of that, you start paying tax, and then you go to 5% and 15%. But essentially, you can take out, somewhere around 70,000 and be in a reasonable, 18 to 23% tax bracket. Where if you remember, you contributed, you were in a 50% tax bracket, and then you took it out when you were in a 20+% tax bracket. Well, you got a 30% arb, right? You got a 30% tax savings by making that decision.
Right. Right. So would you say that it's more a tax strategy than it is an investment strategy?
So that's an interesting way to look at it. I'd say it's both.
Hmm.
I think if you take it as a pure tax strategy, then you'd probably be doing only safe things in there. So if
Right.
you went, I'm going to buy GICs and bonds and just take the difference from a tax perspective, then yes, that's a pure tax strategy. But
Hmm.
if you want to do a combination of tax strategy plus some kind of growth potential as well on top of that,
Hmm.
you can do that as well.
Gotcha. Gotcha. So and then where does the TFSA fit in with all of that as well?
So, um, it's an interesting debate. And so I think that, I guess I would look at it, and I think everybody's situation is different. But I would say, you look at the TFSA and you're comparing the TFSA versus an RSP. And, if you're in your 60s, you've probably already contributed to your RSP, and it probably makes sense to just continue to keep doing that. If you're 25 years old, um, does it make sense to put money into an RSP over a TFSA? The answer is probably not, but everyone's situation is different.
Mm.
So, like, say for example, I don't know, maybe you're a technology individual and you're making 300,000 a year and you're 25. Should you contribute to your RSP? Probably you should do that and the TFSA. But if you're like the average 25-year-old, you don't have a big income, so you're probably not paying a lot of tax right now. The only reason you might do it is because you're going to save some tax. You want to buy a house in the future. When you buy a house, you can take money out of your RSP tax free to for the down payment on the house. So I'd say everyone's situation is different, but I'd say on a high level perspective, if you're a 25-year-old and you're looking to park a few dollars that you've saved, the TFSA is going to be the better choice for you.
Gotcha. So in what situation then would you, because I know we have clients that have TFSAs, RRSPs, and margin or investment accounts, right?
Yep.
So that's the ideal strategy, right? You max out all those things, and then you also have your investment account. How do they trade differently, or do they trade differently on all those accounts?
Yeah, so again, I think it's probably a personal preference for each individual, but I certainly have a view on it. Um, you know, there's a couple of things that you probably think about when you're investing in the different pools. And so, in the investment account, there's pros and cons to being aggressive in there. Obviously, the con is if you make a lot of money, then you're going to pay capital gains taxes. The pro is if you lose some of that money, you got some capital losses that you can use to offset some of those gains.
Mm,
But everything in that open account, you're going to pay tax on. Either it's deferred or you're going to pay dividends or interest. Obviously, with Canadian dividends, you get a dividend tax credit. So there's some benefits to owning dividend paying stocks inside of the investment account. But so some people prefer to be aggressive in there because if they're wrong, then they got losses that they can use. If they've sold the building or if they've done some other things, they can use those losses for that too if they've made some mistakes.
mhm,
I would take a view that you do want to kind of continue to prune that portfolio, even if you are a little bit growthy. You don't want to end up, at 65, 70 and have a $4 million capital gain baked in there because
mm,
that's a giant tax liability that you're going to pass on to the next generation. So generally speaking, I'd say people look at the investment account more of the as the more growthy part of their
mhm.
portfolio. Then when the RSP, I mean, the RSP had historically been really that place where it was more of the safe pool of money in there. So one of the things though that's evolved over the years is obviously yields have come way down, so it's not as effective as it was. And fixed income's different now. You didn't really trade it before because you knew you could get 5, 6%. Where now you'd be more prone to kind of trade that fixed income because yield duration is moving up and down, so there's more money to be made kind of trading fixed income. So it's changed a bit. But one of the unique things that RSPs offer is that if you own US stocks, if you own US stocks in your RSP, you don't pay any withholding tax. So right now, as a Canadian, when you own US stocks in your investment account, you pay a 15% withholding tax. But
Mm,
if you hold that inside the RSP, because of the structure of the RSP as a trust, you don't pay any withholding tax. So there are some benefits to think about, maybe holding some of your US stocks in the RSP.
gotcha.
Yeah.
Man, we're really getting the weeds here. Hey, who knew we're getting in the weeds of the RSPs
All
so
right.
early on in the episode?
Exactly.
Hey,
Right out of the gate.
we should have started with crypto.
Be more fun.
Oh man. Just stick with the RSPs for a minute. We may as well sew it up.
Sure.
Is what are some situations where it doesn't make sense to invest in RSP, right? There'd be there's some other products that would be better for you. What situations would be?
Yeah, so I think if you have a pile of money, you have a pile of revenue and income that's not likely that you'll ever be in a lower tax bracket, then in
Right.
my view, probably doesn't make a lot of sense to do that. So you probably want to look at maybe some other tax planning strategies, and obviously we're going to get an accountant in at some point in the next few episodes, and hopefully we can dig into that in a bit more detail. But you could do some tax planning strategies that might be more effective.
Yeah.
Yeah, there's some ways to save money in different ways and avenues.
Okay. That makes sense. Okay. Anything else you want to say about the RSPs or TFSAs or anything for that matter? It's not boring.
Besides that last rant that we just had about the benefits of it.
Yeah, no, it was good. I was
Yeah,
actually good. I'm just
yeah.
teasing you, but it was good.
Yeah,
Yeah.
and no, I mean TFSAs I didn't talk about too much, but again, let me just probably quick riff on TFSAs because some people still don't understand how they work from that perspective. Obviously, you can put in a certain amount every year, and that amount accumulates. So if you have never used it, then you have um, close to $80,000 you can put into a TFSA right now. But essentially, how they work though is that you put money in, you don't get a tax benefit, but any money that you make in there is tax free. And then if you want to pull money out of it, say your portfolio has grown from 80 to 120, you want to take the 40,000 out that you've made, you pull that 40,000 out, don't pay tax on it, do what you want with it, but it opens that $40,000 of room up again in the TFSA. So in the next calendar year, because you have to wait a year, if you
Mm.
want, you can put that 40,000 back in plus the 6,000 plus inflation back into the
Wow.
TFSA. Yeah,
Wow.
yeah,
Yeah, I bet most people do that. Yeah,
yeah, yeah,
for sure.
yeah.
Okay, awesome. Well, let's move on to something a little more exciting and my favorite subject every week right now.
Yeah,
Either love it or hate it.
yeah,
It's cryptocurrency,
yeah,
and I'll be the first to say, I'll admit it. I'll admit it. It went down. It went down, right? Always gives me a panic attack. Ben always knows when it goes down because I call him immediately and ask him if I should sell it. Uh,
yes.
and then he talks me off a ledge, and then we
Yeah,
move on with our lives.
that's right.
But yeah, so why don't you talk a little bit about what happened with it this week? And
Yeah, it's been a volatile week. I'm just looking here as we talk here on Sunday night. Bitcoin's around 32,600, give or take, and Ethereum is looks like around 1,400. So it's had some volatile sessions as well. But yeah, I mean, look, so we've had multiple conversations around it, and there's this been, I think the overarching old school thinking around financial markets is there's too much volatility for it. But, there's the other school of thought is if you want to make money in an asset class, you want volatility, right? So, I take it and look at it from multiple ways. But, yesterday or last week, we had some days and some decent drawdowns, and I think we were down 10% one of the days last week, Wednesday, Thursday, can't remember exactly. But if we would have had that kind of panic selling 12 months ago, it would have been down, 40, 50%. So you can see that the volumes, what's happening in the volumes, you can see what's happening is that a lot of those kind of panic sells are being bought, and they're being bought at scale, and they're being bought by, I'd say longer term investors as you look at who's been buying those, we'll call it buying the dips. And so it'd be kind of that longer term, less high frequency trading money has been buying it. So I'd say that that'd be the positive. So that was dramatic for sure.
Right. Absolutely.
Yeah,
And I think with anything new like this, there's going to be a lot of skeptics
sure.
still on it, right?
Ton.
Even though I know a lot of our clients have been sending us, negative negative information on it, which is I love getting that stuff. I love seeing the both sides of the coin.
Me too.
Pardon the pun,
Yeah,
Bitcoin. Get it?
I got it.
Uh, I love reading both sides of the coin, and they're,
Yeah,
of course,
yeah,
it's going to have skeletons in the closets, and some stories come out about. But
yeah,
I think that's probably the case for any kind of new asset or anything like that, right? Is it
sure.
there's going to be some sort of negative story about anything, right?
Yeah, for sure. And it's been forever. Like this is the probably the last time we had something similar to this would have been like gold or like maybe commodities trading. Like there hasn't been anything really in my investment career that has the potential to disrupt so many different things
Right,
as this has.
right.
Yeah.
Yeah, I keep my eye on it. Obviously, I have investments in it myself, but
Mm-hmm.
and it's interesting.
Yep.
It's
Yeah.
something new,
Yeah.
right? Somebody, I was listening to Raw Powell's Real Vision on the weekend, and somebody's asking him like, "Are you still a macro guy? Because all you ever talk about is crypto now, right?" And he said, "Well, to be honest, there's nothing else really going on right now to talk about, right? That's as significant as this, which is true. Again,
Yeah.
whatever
Yeah.
your vision, your view on it is, it's pretty much the biggest mover, right?
Yeah.
Or movers,
Yeah.
as far as Ethereum's concerned and Bitcoin is concerned. But like the experts, the guys like that, seem to think. And I'm not sure that I buy into this, but the numbers they're throwing out is they think it's going to go to 100K by summer,
Yeah.
right?
Yeah, and listen, like I read a pretty good deck from somebody that I respect quite a bit in the investment world that manages, $2 billion, like a big investment manager, who gave their annual presentation to their client base, and there was nothing in the deck about it. Nothing
Yeah,
in the deck about crypto, and I was shocked. Like I said to him afterwards, how come? And I guess it was addressed in a Q&A session that I wasn't part of. But so it is still not there yet from an acceptance perspective. And so while the risks continue to be there for central banks, and if it gets banned, I mean that's the risk, that's a key risk which we talk about every week. But if that doesn't happen, which I don't believe it will,
yeah,
when these billion-dollar portfolios decide they're going to take a position in it, I mean, it's a skinny market. And so when it's a skinny or narrow market where there's not a lot of liquidity there, then
yeah,
what happens is you get a squeeze.
yeah.
And so,
And hey, let's call a spade here. Like
mhm,
most like I think I mentioned either on the podcast last week or maybe it was on our weekly roundup that we're the only ones in our institution that are trading it right
mhm,
now. Anyway, and maybe I don't want to say across all institutions, but we're
Mhm.
certainly one of the only advisors that are trading that, right?
Mhm. Yeah.
So, if you're interested in it, Hard Investment Group, little plug there, because the reality is a lot of the other investors or the other just don't have the balls to do it,
Yeah.
right? It's
Yeah.
way too risky. They're
Yeah.
they're they're not willing to take that risk at all.
So let's just talk about that for 1 second too,
Okay.
because I think that it's true. That's how the view. That's kind of the sentiment is I'm taking risk. I'm like, when I look
Yeah.
at it, I'm like, you know, let's just take for example, like your Bitcoin versus Tesla.
Yeah.
And so obviously there's the lovers of Tesla, like this thing's going to the moon. It trades at 600 times earnings. It's worth all of the car companies in the world. And you can have a conversation with someone about buying Tesla. They think it's a great investment. I think it's,
Yeah.
it's crazy. Like
Yeah.
they're not even in the same category. Like Tesla's risk level is through the moon, where Bitcoin's risk level is still risky, but it's way down here from
I
a
love it.
comparison perspective.
I couldn't agree more.
Yeah.
Yeah, I couldn't agree more, and that's a great point.
Yeah.
Um, yeah, I mean that's a really good point. I mean, and I think that's a good segue into, I mentioned different advisors having different strategies, and
Mhm.
we talked a little bit about that last week about most of them just buying funds. Most investors or just buying funds and whatnot. And one of the things we often hear is because we just moved institutions about 2 months ago. So that's often a question that we got is I think a lot of people think that they need to stick with the institution and the investment advisor that uh, they bank with,
Mhm.
right?
Yeah.
Because a lot of them come in through retail banking, right? And then they get introduced to an advisor, and then you
Mhm.
kind of take over the business,
Mhm.
right?
Mhm.
But let's just talk a little bit about that. You know, the advisor isn't you're not buying the bank's strategy,
No,
basically.
no, no. Yeah, so I mean, I think that obviously we did touch a little bit on kind of these different levels within the channels. So,
Hmm.
if you're dealing with a Mr. Banker at the bank, you're going to buy their products. And so, if that person moves, you can kind of interchange that person because they're selling the bank products. But then when you
Right.
get to the next level where you have a significant amount of money invested and you deal with somebody like us, then you're going to have your advisors are the ones that are driving the decisions that are making the choices around whether you're in this stock, bond, even in the funds, right? Like if you go to a guy sitting, 3 offices down from me, he's going to have his own style and his own decision making process. And so, yeah, so ultimately you're dealing with that person. And obviously they're supported by the institution they're at, but you're dealing with that individual.
Right. Absolutely. And it's interesting because we just went through this whole transition from one institution to another. I think it's funny that because the conversations that you have to have when you move, I think a lot of people didn't know that they could actually even move,
Right.
right? They
Yep.
they thought,
For
oh,
sure.
I have my money at this bank and I'm going to keep it there
Yeah.
and that's it. But then you
Yeah.
say, no, no, you can come with me. It doesn't make a difference at all. You can still
Mm,
bank at that same bank,
mm,
right?
mm.
Which I think opens up another thing too, is that I mean, people if they're looking for an advisor, right? We it doesn't have to be in that city either,
Right. Right.
especially nowadays
Yeah.
with I mean advisors are so virtual,
Yeah.
right? You don't have to
Yeah.
sit down, we don't have
Yeah.
to come to your house, have a weird meeting with no shoes on, everybody's in their sock feet, at the kitchen table and having those ones. Now we can have a meeting like this,
Yeah.
right?
Yeah.
So you could, I mean, essentially we can go cross province as well, right?
Yeah.
Or cross provinces,
Yeah. Yeah. Yeah.
right?
Yeah, for sure. I mean, we have clients in BC and Calgary and Winnipeg and
Yeah.
in Quebec and Newfoundland and
Yeah.
Halifax. So yeah, for sure.
A- Absolutely. So
Yep.
if you're listening to this, and this is a second plug, we don't normally do that,
Yeah.
but I'm using it as an example, right?
Yeah. Yeah.
Is that if you're in BC and you've been listening to this podcast and you like what we do, well, they could literally just call us up. We could have a meeting with them, and we
Yeah.
could then become their advisors. right?
For sure,
Same
for sure.
same paperwork.
Yeah,
Absolutely. Right.
yeah. Yeah, so oftentimes that's so had a conversation with a prospect on Friday, and as we often do. So the questions and the conversations become, well, what is it that you do that's different? How do I compare you to another advisor? How do I decide if you're the right fit for me? Like, these are all obviously soft questions, and it's hard to kind of put your finger on that specifically to see what it is that you want. But one of the answers to that question that I had for this client, and I think ultimately, though, which I'll get to in 1 second, but you know I've always said this, and when he asked me this, he said, "Have you lost clients before?" And of course. And I said, what it comes down to is the relationship is between you and me. So, if we're on the same page and we know we're going in the same direction, then we work together to get there. Like, we don't want to have a combative relationship. And so some advisors have kind of that combative relationship with their clients. They want to argue and discuss and fight through things. That's not going to be the relationship I'm going to have. And if you want to have that relationship with your advisor, that's going to be with somebody else. So you gotta spend a lot of time trying to see what that right fit is for you. But you got to have that kind of that mutual goal with, I'm trying to get you somewhere, trying to get you to where you need to be. And so let's see how we do that together, and we work through that. But I'd say the biggest differentiator, though, that we have is it's really the risk management process, and really thinking about managing that downside. And so I don't know if we had this conversation or not last week, but you know I don't think so, because I met a client this week, and we talked a little bit about performance, and I won't say about the performance this year, but we outperformed their benchmark, and we had 10% of the drawdown of the index. And so when I say that, you say the what happened is your portfolio was $1 million coming into February 1st, and it dropped to 600,000, because that's what the TSX did. It dropped 37%, and then closed up about 2-3% by the end of the calendar year for the TSX for the calendar year. So some people look at that as, okay, well, if I went to sleep on January 1st and then woke up December 31st and I saw that I was up 3, probably there's nobody the wiser. But if you're $1 million, when you looked at it on March 23rd, it was worth $600,000. You're gonna have a panic attack, and lots of people did, and lots of people were panicked, and lots of advisors I talked to through that period of time were panicked as well. And my clients didn't feel that drawdown, because coming into this year, I thought we are going to have a mild recession. So I bought some long bonds and portfolios, owned some puts and some protection, and a lot of things that other people do, because I think it's important to be active. And, like, even though maybe you get to a similar destination, you don't want to be in a roller coaster. I think that's the biggest challenge that people have. But it's what we do that's different, and we're really managing that risk.
Right. Yeah, absolutely. That's a great point. Great point. So let's, in that kind of same vein, this is actually the last question I have, but I noticed, and I've been reading a lot about the market, right, and kind of looking at its history in the last little while and how people invest and whatnot. And I actually noticed that fewer and fewer people year over year seem to be investing in the stock market,
Yeah.
with the exception of the last 9 months,
Yeah.
right?
Yeah. Yeah.
So why do you think that is? Why do you think leading up to that point? I think we know the answer. Well, actually, maybe we don't know the answer. So maybe you can talk about before that 9 months and after the 9 months.
Yeah.
Yeah.
Yeah. So leading into it, I think a lot of things were driving that. I think there was a lot less interest in investing in stocks. People were long feeling the effects of the great financial crisis, 2008, 2009, obviously. And so that shook a lot of people out of the market, and they looked to do other things. Whether they're investing in businesses or real estate or other types of investments, they're looking for alternative ways. And so, you know, if you've been, say you're in your kind of mid 50s, early 60s, you've gone through the worst bear markets in history a couple of times. And so that does certainly shake the foundation of how you invest. And like you remember that, obviously, right? You feel the losses more than you feel the wins. So like the people continue to have that kind of mentality. And additionally, if you're, a Gen Y, and you're early in your career, 2008, 2009, you didn't have any money. So it took a long time before you had money saved, before you can invest in things. And so, I think you had a lot less people investing and kind of trading the market. And then I'd say in the last 9 months, what you've had a total resurgence of day trading, which is circa 1999, 2000. And so you've had a kind of everybody come flooding back to this market where, and now you can pick up your phone, right, and download an app and start trading for free. So you can
Mhm.
trade for free now.
Yeah.
Like it's crazy,
Yeah.
right?
Yeah.
So you've had a lot of people, like, whether in Canada or the US. In the US, you can look at the statistics. I'm sure it's in one of my dailies, where it shows where all the different demographics spent their money that they got from the government in the US. And a big in the top five, and all demographics in the top five, it went to stocks. And so you've had,
I would have guessed hot tubs.
depending what part of the United States.
Hey, hey, there's that Main Street mentality coming out again. Hey.
Exactly. So it's come back to stocks, and you've seen like Davy Day Trader, right? You see these guys come out. I don't know if you saw this TikTok last week about this couple from the central of the United States, talking about how they just stay at home and they trade stocks all day. They just buy stock, and when it goes up, they just sell it and they take the profit, and then they do it again, and they just buy it and they trade, and like, so they're retired and life's great for them. It's easy.
Oh wow. Yeah, man, that's isn't it easy like that? That's how I will. Why don't we do that? Isn't that our
So
job?
yeah, exactly. So I'm certain that's not going to end well. I'm not going to be funny for
No,
them, for sure.
no.
But so because of the ease of it, because of the free money,
Yeah,
what we've seen too is that because the money is limited, right? Like say you get $2,000, what's the best way to risk that $2,000? And the best way to risk that $2,000 is to trade options, because if you trade options, you get leverage, right? So
right.
you've seen an explosion in option trading, and primarily on the call side, right? Because if you're buying a call, you're speculating that the stock's going to go higher. And so
Right.
you've seen like off the charts call buying, and lots of days in the last multiple months, you've seen more call buying volume than you've seen volume in the underlying stocks in some of
Hmm,
these. We've never seen this in history.
hmm. Interesting.
Yeah.
Yeah, interesting.
Yeah.
Oh man. Well, but I mean that's the thing though about I think markets like this make people nervous, but I think people the reason why it's like that is because of the volatility, right? I mean, the opportunity is in the volatility. If it was just, flatlined or little ups and downs, then you're not going to have that amount of day trading, right? Because it's
For
just
sure.
not those predictable spikes for sure.
Yeah.
Good stuff. Okay. Um moving on. What else do you have? Do you have anything?
So the only thing that I think that is going to be the most important from a market perspective here is what's going to happen to the U.S. dollar and volatility. So right now, like, this volatility's been elevated, And so coming into the start of last year, we had volatility like in the single digits, 9, 10, 11, and it was stuck there for about 2 years. Like that's a dream for ETFs, right? Because no volatility, kind of an upward trending market. This is easy. We don't need anybody to help us. And then we had volatility explode in 2000 or in the start of this year, and then it stayed elevated. So it went up to, I think something like 80 VIX, came back down to 40, 30, kind of traded 20 to 30 for a long time. Now it's coming down into the lower 20s volatility, which is still historically high. So I'm going to be watching that volatility spectrum and US dollar. If we start to see vol move up again into the high 20s, low 30s, you're likely getting a stronger US dollar and you're likely getting weaker risk assets. So that again, that plays a part in everything you do. So those two key things I think are very important to watch here. Yeah.
Okay, great.
Yeah.
Awesome. Well, man,
It's a good one.
man, they fly by, and we're getting better. We're getting better for
We
sure.
are.
Hey, the
We
witty
are
banter is just off the charts for this one. Hey,
getting there.
yeah, exactly. Oh, because we want to keep it legal. You wanted to
Yes.
read. You
Yes.
wanted to
Yes.
read a
Yes.
little
Yes. Yes.
disclaimer.
For sure. So
We'll let it rip.
all right, let's go. So this is not intended to be investment advice. You should always speak with a licensed advisor before proceeding on any investment strategy. Everyone has their own risk tolerance and you should adhere to that. This broadcast is for information purposes only and are the opinions of the Hart Investment Group or any guests. That's it.
Great.
Yeah.
Awesome.
Yeah.
Okay, well, that's episode 3 in the bank. We think episode 4 we may be having a special guest. So if not 4, then probably 5, but hopefully number 4. We won't let that out of the bag yet, who that's going to be, but we're excited. We're going to hopefully have more guests on moving forward.
Yep.
Get a little more specific on things. So yeah, so that's it. So thanks everybody for tuning in. Think at Heart, episode 3 in the bag. Have a good
Beauty.
one.
Thanks.
See you next week.